When tech and AI stocks are ripping to all-time highs, everybody talks big. Everyone sits on the sidelines saying, man, I just need a 20% pullback so I can load the truck up. Well, guess what? The dip is officially here. Stocks in this exact matchup are down 15, 20%, and in SanDisk's case, slashed by over 50% from recent highs. Now that the red candles are actually on your screen, what are you going to do? Run away because of a headline, or capitalize on the mispricing? If you check the news right now, the narrative is terrifying. They are screaming that a state-backed Chinese company has cracked deep ultraviolet lithography. They are warning that a massive new competitor is going public, armed with billions to flood the market with cheap supply and crush global pricing power. And Wall Street is starting to sweat over the massive capital expenditures big tech is burning on data centers. It sounds like a total collapse of the supercycle. But it is unproven noise. We are watching a classic knee-jerk overreaction where the market is confusing legacy commodity manufacturing with bleeding-edge AI infrastructure. As someone who runs a highly aggressive tech-heavy portfolio, these are the exact moments of dislocation that I hunt for. Today, we are putting 6 of the biggest names in the memory and semiconductor space into the ring. We're going to strip away the panic, run the raw fundamentals, and figure out which of these companies is actually a screaming buy on this massive dip. A quick disclaimer before we lock the cage. Investing has risk. Do your own research. This is not financial advice, and I'm not a licensed financial advisor. This specific face-off matters right now because investor behavioral traps are flashing red across the entire sector. The market is attempting to price in a doomsday scenario for memory chips, but they are getting the structural mechanics completely wrong. To understand why this sell-off is a massive opportunity, think of memory chip stocks like baking. China just announced they built a brand new homegrown oven. That sounds scary until you realize it's an old school oven that only bakes classic store-bought cupcakes. That is the commodity memory used in cheap smartphones and basic consumer gadgets. The AI revolution doesn't run on basic cupcakes. It requires hyper-advanced 12-layer custom wedding cakes. We call that high bandwidth memory, and that can only be baked using an atomic precision laser kitchen that Western allies completely control. Building a bigger cupcake oven doesn't mean you can suddenly bake 12-story laser cakes. They aren't even in the same kitchen. And here's the reality check the algorithms missed. Not a single major tech giant has canceled or reduced an order for advanced memory. High bandwidth capacity is completely booked solid for the next 12 to 18 months. The hyperscalers are treating AI infrastructure as an existential battle for survival. Every major player is increasing their capital expenditures because if they miss the AI wave, they lose their entire moat. You have a situation where share prices have dropped 15% to 50% across the board, but their actual revenue forecasts and earnings expectations went up. When fear drives valuations down while the underlying demand remains bulletproof, you get a rare window to accumulate world-class assets at half-off prices. But you cannot buy blind. You have to know which companies are actually driving the margins. Let's meet the contenders. We have Micron, the leading U.S. powerhouse in high-bandwidth memory. We have Western Digital, the veteran data storage giant trying to navigate the cycle. Broadcom steps in as the dominant force in AI networking and custom silicon. SanDisk enters the pure-play flash memory specialist. Lam Research brings the picks and shovels as the elite fabrication equipment provider. And finally, Seagate represents the traditional hard drive and mass capacity storage guard. This is not a casual review of balance sheets. This is a 6-way brawl to determine exactly where the capital belongs while the market is bleeding. We have the undisputed leaders in advanced packaging taking on the legacy storage giants, and the companies building the machines taking on the companies selling the chips. We're going to stress test their profitability, their cash flow, their balance sheet safety, and exactly what they cost right now. Here are the rules of engagement. Every metric gets ranked. The strongest company gets 3 points, second place 2 points, and third place takes 1 point. At the end of 6 rounds, the math makes the decision for us. We strip out the headlines, we ignore the Chinese oven panic, and we let the raw financial truth crown the winner. It's time to step into the ring. Round 1 is net profit margin. This tests how much money actually drops to the bottom line after the lights are kept on. It shows us who possesses genuine pricing power in a market terrified of cheap overseas supply. Micron leads at 55.9%. Western Digital is right behind at 55.3%. Broadcom 38.8%, SanDisk 34.2%, Lam Research 30.9%, and Seagate is last at 21.6%. Micron takes the win here by a razor-thin margin over Western Digital. Scoreboard, Micron 3, Western Digital 2, Broadcom 1. Round 2 is revenue growth forecast. This tracks the top-line trajectory to see who is actually capturing the aggressive AI spending boom. Growth is the only way to outrun a shifting macroeconomic cycle. Top to bottom, it goes Micron at a staggering 246.2%, SanDisk 168.2%, Broadcom 65.6%, Western Digital 34.8%, Seagate 32.4%, and Lam Research trailing at 25.6%. Micron completely dominated this category. Scoreboard, Micron 6, Western Digital 2, Broadcom 2, SanDisk 2. Micron is coming out swinging with a massive early lead, but high growth means nothing if management is burning cash to get it. Let's see who is actually efficient. Round 3 is cash return on invested capital. This measures how effectively management is using the capital they deploy to generate real cash. We need to know that the billions being spent on fabrication expansion are actually turning into tangible returns. From the strongest to the weakest, the order is Seagate 50.3%, Lam Research 42.4%, SanDisk 35.2%, Micron 30.1%, Western Digital 23.9%, and Broadcom bringing up the rear 22.6%. Seagate shocked the heavyweights and took the top spot. Scoreboard, Micron 6, SanDisk 3, Seagate 3, Western Digital 2, Broadcom 2, Lam Research 2. Round 4 is levered free cash flow margin. Levered free cash flow is the cash remaining after a company has paid its operating expenses, capital expenditures, and all its debt obligations. We want to see who actually has the cash freedom to weather a storm or aggressively buy back stock. Broadcom comes in first at 43.4%. SanDisk is next, 33.8%, Micron 29%, Lam Research 27.7%, Western Digital 24.7%, and Seagate finishes 21.9%. Broadcom flexes its structural advantage to secure the points. Scoreboard, Micron 7, Broadcom 5, SanDisk 5, Seagate 3, Western Digital 2, Lam Research 2. The profitability and efficiency tests are done, but none of it matters if the market is asking you to overpay. It's time to look at the price tags. Round 5 is profit-adjusted PE ratio. This is the valuation versus profitability test. Lower is better. A stock can look completely fine on raw forward PE, but once you force it against actual profit margin, the picture can change incredibly fast. The ranking is Micron leading the pack at 0.22, SanDisk next at 0.54, Broadcom 0.81, Western Digital 0.82, Lam Research 1.65, and Seagate is dead last 2.54. Seagate is roughly 12 times more expensive per unit of profit than Micron. Micron takes the commanding win. Scoreboard, Micron 10, SanDisk 7, Broadcom 6, Seagate 3, Western Digital 2, Lam Research 2. Round 6 is debt to total equity. This is the balance sheet solvency check. We need to know who has the leverage flexibility to survive a cyclical downturn without diluting shareholders. SanDisk leads at an incredibly lean 1.5%. Micron is next at 6.3%, Western Digital 17.8%, Lam Research 35.3%, Broadcom 74%, and Seagate is carrying a massive 381.6%. SanDisk grabs the final victory of the fight. Scoreboard, Micron 12, SanDisk 10, Broadcom 6, Western Digital 3, Seagate 3, Lam Research 2. The math has spoken, and this scorecard paints a very specific picture of the current semiconductor landscape. Micron controlled this face-off from the opening bell, proving that its positioning in the high-bandwidth memory space is delivering overwhelming fundamental strength. While the broader market is panicking over Chinese cupcake ovens, Micron is sitting on elite profit margins and explosive growth forecasts that the legacy storage guys simply cannot touch. SanDisk put up an incredibly respectable fight, proving that operating as a pure-play flash business with a pristine balance sheet gives them a massive structural advantage, especially when the stock is trading at a staggering 50% discount to recent highs. Broadcom showed its legendary cash flow generation, but struggled slightly when we forced its valuation against its raw margins. The real story at the bottom of the board is the extreme vulnerability of companies carrying massive debt loads or slow growth in a market that is demanding absolute perfection to survive this pullback. The winner of this face-off is Micron with a dominant 12 points. This win means that despite the terrifying headlines and the aggressive sector rotation, Micron's fundamentals are fundamentally de-risked, deeply profitable, and currently trading at an absurd discount relative to the cash they generate. This loss does not mean the rest of the sector is uninvestable, but it does prove you have to be wildly selective about where you deploy your capital when the dip arrives. SanDisk is an absolute cash flow fortress, trading at half off for anyone looking for a clean, debt-free play. Broadcom remains a required networking staple, even if you have to pay a slight premium for their ecosystem. Western Digital, Lam Research, and Seagate simply lack the aggressive growth and lean balance sheets required to dethrone the true leaders of the AI hardware arms race. A 50% discount on a great business only helps if you have the framework and confidence to execute when red candles hit the screen. That's exactly why I manage our Patreon community. It's designed for serious investors who want a disciplined, repeatable approach to long-term wealth building. We focus on core stock holdings, high-growth AI allocations, and clear risk management strategies. You see every move I make in my own portfolio, along with direct questions and answers. And if you don't trade options, that's completely fine. Our primary emphasis is always long-term stock and ETF investing. If you're ready to stop guessing, master your allocation, and build a retirement portfolio with true clarity, hit the link in the description and join the Patreon right now. If you made it this far, drop by the discount in the comments. Tribe check. We don't panic over noisy headlines. We buy world-class fundamentals on sale.